You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Well, episode 25. I was pretty confident I'd make it, kind of like making it to the finish line of a 100-mile race, but it still feels like a crazy milestone that I've done 25 of these Builder's Mindset episodes, just sharing the things about the home building industry that I enjoy, that I like. So I thought we would do something, just a little special. Nothing crazy, but 25th episode, and it is 2025. I know we're well into February, but I still kind of feel like that the home building year is heating up. We're not quite done with earnings season. We've got a couple of more reports to come out. I'll talk about that in a second, but 2024. For 25, episode number 25, let's just kind of we'll do a few high level things and talk about some of the big things that have happened or happening now. First off, like mergers, right? Mergers. There's a fair number of mergers last year. Lennar bought Rush Coleman, Meritage bought Elliott Homes, and a whole bunch of others. I'm not going to list them all, but I just read, and already 2025 is off to a pretty active start when it comes to mergers, and you've got all kinds of stuff. You've got publics buying privates, which is typical. We're used to seeing that. We've got some private mergers coming together to better scale, which I think is wise. It's going to become more and more competitive. As I think we mentioned, as of 2023, the public home builders account for over 50% of the closings. And it's funny, a friend of mine just went to take a regional role at one of the largest builders in the country, and we were talking about how that region has more closings than some of the builders in the top 6 to 10. And so scale is going to become a big thing, in my opinion. So I believe, and I think there's a lot of forecasting for a lot of merger activity this year. But the interesting one that I just read about, and John McManus at Builders Daily did a phenomenal article on this. I think it's a good read. JPMorgan purchased or merged. They're creating a strategic partnership with Paran Builders and their funding group out of Georgia, which is going to get them into the BTR market. And as I said, I'll share the link to the Builders Daily article, because it's a really great article by John McManus and the team over there, just sort of outlining why this is really interesting in terms of, build for rent, single family for rent has been a lot of talk. And I want to say, like, probably a few years ago, it was super, super hot. Like, everybody's talking about it. All the big builders are talking about getting into it and doing it. And it's kind of cooled down, at least in terms of the information that's out there. But what's interesting about this, and they point out in the article, is that prior to this, these typical institutional investors that we hear so much about, like that they're dominating the rental market, which is just really, really just bogus information. Like the prior administration at the national level was trying to push this narrative that they owned so many of these rentals, and it wasn't really true statistically speaking. It's very low single digits, I think, that they own. But this, as the article pointed out, and I agree with them, could be, and I'll say why it's be a potential game changer, because now you've got a behemoth institutional investing group, like the JPMorgan, suite of just the amount of horsepower that they have just in so many facets. That they now have a building arm. So they can step out of this whole purchasing lots and purchasing existing stock from others, or going to negotiate, from the Lennars or the Hortons of the world to buy tracts of home from them, and what's that cost? And the implication here was like, one, they'll have this arm and this mechanism to basically be their own machine, their own producer, and two, thereby control cost, which was interesting because I commented on LinkedIn where John shared this post, and I believe this is my true thing. I think that it's going to become, it could turn into something really big, but I think most of the competitors, like the JPMorgan type competitors who would like dabble into this world of things, are going to potentially be in a little bit of a wait and see mentality, and I believe that's the case because home building is still a very local market when it comes to labor. We have not yet cracked the Pandora's box code, the Da Vinci code of like how to effectively and efficiently make homes prefabricated in a factory, controlled environment, get it to the job sites, meet all the local codes, and assemble it in a way that is cost effective. Why that is a phenomenal question. I have yet to see a model that shows that you can do that at scale, at cost, that's competitive with site build. But because of that, though, the numbers and the metrics for home building and the margins center around this very high volume, low margin, economics. And so what I think a lot of the potential competitors to JPMorgan in this particular venture of getting into SFR BTR, I think a bunch of them are going to wait and see sort of see how, when they try to scale that and take it, which my understanding is they're going to start off with a couple communities, one in Atlanta area, which is where they're out of, and then one in Nashville. And Nashville, I think, will play into my belief of what's the potential issues they could run into. Land development is typically two things: late and over budget. Almost unassuredly, we'll talk about the land light strategy because that will help alleviate that problem in one fashion or another. But I think their competitors are going to be in this wait and see mode. I think they're going to want to see how this strategic partnership, when they infuse capital into it, does it become efficient, and does it build homes at scale for the current pricing or better repetitively? And you can go over budget really fast in construction. It does not take a lot. Land development, it usually already happens on, but even on the directs, we call sticks and bricks. If you're not a seasoned expert with real knowledge of the trade base, the codes, scope, specs, what you need to put in these homes, how you need to design them, engineer them, and bring them to market, I tell you, and I've talked lots and lots and lots about this, it is as much art as it is science. And a lot of builders currently working, and the earnings report would talk about it, but you can look, and I think a huge part of why there's such a wide spread between margins from, the most profitable public home builders to the least profitable, I think a chunk of it has to do with just how they manage that whole product development, purchasing, and construction operations at the local levels. I've also seen, like, within a given division or within a given company, one division to the next can be completely different. So I think their competitors are going to be wait and see how this pans out for them, see how some of their reporting goes, see how they talk about, do they meet their costs? Do they exceed their costs? Do they outperform, underperform? And I think that it's going to be a little bit of a wait and see. And it's interesting that they picked Nashville as one of the first two areas that they're going to dive into, because the little experience I have in Nashville, it's not the easiest market to get into. Case in point, if you look at Nashville, if you go back 10 years, Nashville's not a big market. It's growing. It's got like Tennessee in general has, a lot of people are moving there, but I've watched a fair number of builders enter into that market, and you've got topography that you have to deal with, which creates, foundation issues. You've got a very localized trade base that, can be suspect at best. And I've seen a lot of builders, or know of a lot of builders that have gone into Nashville and seen their actual directs go 5, 10, 15 bucks more than they thought they were going to be. And so it's not your typical Southeast, low cost market like the Carolinas, like Georgia, like Florida. It is unique. And when you look around the United States, you have a fair amount of that. You have some markets that might look good, like good rental markets, where the trade base and the complexity of building is different. Like places like Salt Lake, very, very insular market. Denver, lots of challenges with basements, foundations, frost lines, and trade base. So I think it'll be interesting to see how this one plays out. I'm looking forward to watching it, and I hope the folks I hope John and the team over there put out some more stuff and track it and share some of that great knowledge and wisdom with us as they go forward in that. So with that, there, we talk about mergers. Now let's dive into, we talked a little bit about kind of this land light strategy, because I said land development is typically two things: late and over budget. It's just kind of the running joke. And so I think part of this land light strategy will help on the front end entitlement process, right? Get that stuff off books so you're not carrying a 5, 10, 15, $20 million piece of dirt all the way through, the approval process, the entitlement process, the mapping process, where it may be, and in friendly areas it can be 18 months, and in pain in the ass areas like California, it could be 3 years. So there's that benefit, and that benefit that doesn't go away. I mean, it's still somewhere, but this concept of the land light strategy, if land development is always late and over budget, then what we take out of the variability there when we go to a true land light and I start buying finished lots is I at least know my cost of land and I know when the lots are available. I don't think it's going to ultimately save a ton of money on that part of things, unless you have these REITs like Millrose that, is officially spun off now, and Lennar's got off the ground. It's going to be a fee-based REIT. If they get really, really good at developing land and they do it at scale, and then it's, this idea of like Millrose will be this fee-based, situation where it's not like my understanding, they're not there to make massive amounts of profit off the appreciation of the land. It's really more about a fee-based structure, which that could have some significant benefits. But the land light strategy at the beginning and the outset will help the carry and the return on invested capital for sure. But I don't know if in the short run, in the next 2 to 3 years, it's really going to do a whole heck of a lot to bring the overall cost of land down. It may, and I could be surprised. And I think with what Lennar's done with Millrose, that's probably one of the best ways to tackle that as quickly as possible. So more on that to come. Another thing we're just going to have to wait and see. Really excited about what comes with the Millrose formation, and can't wait to check it out in 6 months, 12 months, and beyond, because I think it's got a ton of potential to help the industry from a land availability, finished lots, and hopefully some cost perspective through development at scale. And then as we talked about, like I said, I'm a wait and see for this JPMorgan build to rent thing, because there's a significant variation in profitability from, say, out of the public home builders, from the best performing to the lowest performing, when you look at both, their pre-tax and post-tax profit percentage, their SG&A expenses, just, kind of how they're operating. And it'll be interesting. And you'll see that again. We're about to come out with our third earnings report summary. We had a couple of, I think we're still waiting on LGI and Green Brick, who will be reporting, or their call is, I think LGI's call is the 25th. And I don't want to put it out before I have them all. But it is up to date and ready to go. And so that will be coming out hopefully. I was hoping to do it right before IBS, but it looks like it might actually drop during IBS or the Friday after, the Monday right after. It'll probably realistically going to be the Monday right after IBS, because then everybody will be in and the summary will be done, and looking forward to that. So if you want that, the link will be in the show notes below for to sign up for the email list, so that when that comes out, it'll be right in your inbox. So, all right, land light. Let's talk. I mentioned that a little bit already, but let's talk about it a little bit from this perspective. Is, as I was reading through all of the transcripts from all the earnings reports of the public home builders, looking at all the information, I think if I had to summarize this earnings report up into one thing, it would be land light. I have to believe and I think it's a little weird now because of the Sekisui MDC thing. I have to go back. I think right now we'll have 19 public home builders. I think it'll be 20 with Sekisui, but they don't close their books till January 31st. And so I'm not going to wait until I'm going to publish, even if I don't. MDC's not doing one, as my understanding, and I'm not going to wait until like March, like mid-March or whatever, to publish. We'll probably circle back and do an addendum to the earnings report. But I would say out of those, 19, and I think I've actually been through 11 or 12 already, I think land light has come up at least 50% of the reports that I've read. They're all talking about it being land light, being efficient, but they're still talking about like their percent controlled lots. They want the best of both worlds. They want to be in charge of their future. They want to be in control of their future, but they also want to be land light. So they don't want to have that on their books. And so there's a lot of talk about what that means for these home builders. If the entire industry truly moves to a land light strategy, it will be interesting how that plays out, because if they use land brokers, that typically costs more money, right? And capital's expensive now. I know the Treasury is talking about, tinkering with long-term interest rates, which may, help things like apartment loans, big loans for apartments, big loans for land development, and capital for that. So that remains to be seen. But, if you're land light because you're doing land broker deals, you're paying more for your land ultimately at the end of the day, but you do shield yourself, you have less risk. If you're land light because you're trying to option more land, that is like not really, in my opinion, truly land light, because you have to take the land, own the land, and develop the land to get it to market. And you either have to do that by buying it in chunks, some reasonable chunks, or you do it by using a land banker. And as we talked, that's going to cost more money. And then what I've found in my history and experience is when builders try to get really cute with like how they option takedowns, and they try to stage, let's say they've got a 300 unit community and they're trying to do their land development in phases, and they're going to chunk that into 3 phases. I have found more often than not that just adds to the problems that I talked about that land development always has, which is over budget and late. And so when they try to phase that to manage their cash flow, it may at the end of the day still make the cash flow a little bit better, but operationally at the division level, everything that I've seen, it just causes more and more headaches. But another thing that'll be remaining to be seen. I think the theme for 2025 is going to be mergers and acquisitions, land light strategy / Milrose, build for rent and single family for rent, build to rent, how that all plays out now with this JPMorgan thing. And earnings, obviously, earnings are going to be huge because everybody's already starting to report a little bit of a pinch in earnings because of, they're taking the incentives deeper and further than they thought and they hoped. And then the other thing I think is going to be the theme for 2025 will be, we'll call it, survive 2025. Why do I say that? Not gloom and doom. You know me, I'm not a gloom and doom guy. But I think a lot of the builders that I saw in reading the reports, they're reporting pretty good numbers in terms of the growth. Community counts are up year over year. Closings are up year over year. In a lot of instances, backlog is down. Here's the difficulty: backlog is down, but sales are up for the quarter year over year. And so I think what we're starting to see with backlog down is, it's getting tougher to make these sales. Can rates are typically the same or higher, and they're trying to produce some amount of growth. They're all forecasting lower margins from what I can tell right now out of the gate, like from year over year, but they're all trying to get some level of growth. Nobody likes regression when it comes to growth. They all want to progress. And so I think survive 25 from that perspective. Just close more homes than you did last year is going to be the goal. We'll see if they all manage to do that or not. And then we're going to wrap up this 25th episode with IBS. So IBS is coming up. I'll be going to IBS, not this, I think it's the 22nd, 3rd, and 4th, something like that. It's actually it's like the last Tuesday, Wednesday, and Thursday of the month. I think it's the 25th, 26th, 27th. Anyway, I'll be there. I'll be visiting with some friends, meeting some suppliers, and just all kinds of other folks. I'll be around. If you'd like to catch up, let me know. Might do a few little interviews if I can schedule some things, and might just do some touring around, checking things out, and seeing if there's anything new and exciting. And we'll put together. I'll probably record an episode from IBS, maybe not from the floor, but from Vegas. And we're looking forward to it. It's always a great time and a great show and a great event. And it'll be interesting to see if any of the things we're talking about here are hot topics at IBS. Not quite sure, because we focus more on, kind of some of the other stuff. Love the products, love the new stuff and the innovation, and it'll be fun as always. Looking forward to it. So with that, I cannot thank you enough if you've listened before. I can't thank you enough if this is your first episode. Welcome. Hope you enjoyed our 25th episode. We look forward to the next 25, and we plan to continue to do these through in perpetuity. As well. So, and then also we started a new podcast, a faith-based podcast. For those of you who might be faith-based, if you're interested, it's called Built on Faith. We'll put the link in the show notes below for that if you're interested. It's kind of a little bit about my journey through my professional career, and how I ended up where I ended up, and how I ended up going and getting back into my faith at this ripe old age of 54 that I am. So anyway, we really truly appreciate you. Thank you so much for tuning in. As I said, if it's your first episode, thanks for joining us. If you're a repeat listener, thank you. We truly, truly appreciate you. If you're gonna be at the Builders Show, I'll put the booth that I'll be hanging out with most of the time. I'll put the booth number in the show notes as well. And we look forward to seeing you there, and hope you're having a great start to your 2025. And I'll leave you with one last thought. As you're thinking about what you're going to do in 2025, don't think it's too late to have new goals and new aspirations. And what I would say is if any part of your home building operations, that is purchasing, product development, construction, customer service, if any part of how that works together, how that part of your machine or any facet of that, any interaction with that, if it is not getting you what you would call, if I asked you to grade it between 1 to 10, and if it's not a 9 or better, we should talk. Feel free to reach out. We're going to open up a few business-to-business consulting and coaching opportunities. Not too many. We've got probably only going to have about 2 or 3 available for the first half of this year, and then maybe 2 or 3 on the back half of the year, maybe. Not sure if we're going to phase those out or not, because we're also launching our group program, which we hope can be more accessible to more builders and trade partners. That's called the Warrior Profit Academy. That's a monthly program where you have a couple of tiers and options. So more information in the show notes if you're interested in that as well, or go to my LinkedIn page, lots there. And once again, we appreciate all of you. Thank you so much for listening to another episode of The Builder's Mindset, and we hope to see you in week after next at IBS. Have an amazing day.
You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.